Good morning, sir.
Good morning. Good morning, James. Good morning, all.
Thank you very much for doing this again. I know we've done it before,
Yeah.
but it is useful, I think, to come back and revisit these things. And I think for the sake of people that won't necessarily have seen you or heard of the fund before, maybe we could start off with you just introducing what Ecofin does and the Global Utilities Fund does and what it's trying to achieve, if you don't mind, please.
Yeah, sure, James. Thank you for the introduction. Yes, Ecofin, we are a specialist of sustainable investment. We've been around actually for more than 30 years in London. Assets under management, just above $2 billion. We still count in dollars. We very much aim at delivering high returns while also preserving the planet. So it's a combination of ecology and finance, as the name indicated at its foundation in 1991. I joined Ecofin myself about 15 years ago as a portfolio manager, and I'm particularly in charge of the strategy which follows your trust that we're going to talk about today. Ecofin, Global Utilities and Infrastructure Trust, launched in 2016, out of a strategy which actually Ecofin has been running in different formats for over 15 years. What I'm offering to do in the next few minutes is starting with a brief snapshot of the past performance. I'll introduce the main characteristics of the strategy, and then more importantly, I think I'll give you what we believe represents a significant and compelling opportunity to invest in the space at the moment, with some short-term drivers, but much more importantly, underlying medium and long-term supportive drivers of the universe and the strategy. So first of all, on this slide, past performance. As you can see, since 2016, the NAV has increased by a compound average of 11.5% per annum, 15.7% per annum for the share price. Last year, 2022, I think it's an interesting year. I'll come back on that. The NAV was up 5.7% and share price total return of 12.9%. That was for last year, calendar year 2022. We are showing some indices here for reference purposes, but we are clearly driven by a focus on absolute return, much more than trying to benchmark a portfolio clearly. Now, the next slide is a strategy overview. Next couple of slides. In a nutshell, so first of all, we only invest in listed equities. We have a global perspective to the space, and we want to both ensure some capital preservation to the portfolio and also gain some exposure to structural growth. When we say global, it's very much a balance between North America and Europe. We've decided to cap exposure to emerging markets at 10%. Not so much that we don't see opportunities in emerging markets, but much more because this is quite often with a different type of risk profile. So we tend to retain a pretty stable, relatively stable balance between North America and Europe for something like close to 85% of the portfolio. The rest of the world also accounts for a small proportion. Income is at the center of the upper part of the slide. This is referring obviously to the capital preservation characteristic and objective I was talking about. The portfolio typically yields around 4%. And you actually have a board which has proved supportive of dividend income and has even recently again raised the quarterly dividend of the trust. So income, clearly, but also growth. And what we mean by growth is much more about the structural underlying growth drivers of the space, largely related to the energy transition phenomenon. So we are hardly exposed to cyclical growth factors and much more interested in the long-term structural drivers. Typically, we expect our portfolio to grow its dividends by 5 to 7% per annum. So if you put those two on top of one another, a dividend yield of 4, with dividends growing at 5 to 7, you roughly get to double-digit total return per annum, which is within our objective of 6 to 12% per annum. That gives you an idea of the profile of the strategy. And as I mentioned as an introduction, so far, inception to date, we're pretty much towards the upper end of the total return objective. Investment universe, traditional definition of utilities and infrastructure with 3 subsegments: electric and gas utilities, with obviously a growing proportion of renewables; environmental services, that's mostly water and waste; and finally transportation infrastructure with toll roads, airports, tunnels. What is the common characteristic between all those subsectors? This you can see on page 5, actually, the next page. We want asset-backed services based on long-term contracts. That's a precondition. Those long-term contracts give us high degrees of predictability of the future cash flows, and those predictable cash flows ensure sustainable and growing dividends, with actually also good inflation hedging characteristics as part of the universe and particularly of our portfolio. So obviously this type of definition implies that we do not invest in the equipment manufacturers that some people would typically include in infrastructure. We are very much interested in the asset-backed services part of the value chain. So that's for the main characteristics of the universe. Then moving to the why now, or the opportunity that we see, I would suggest that if you have one slide to remember from this presentation to keep in mind, is probably that one. Because I think this is a phenomenon which is largely underperceived, undervalued by equity investors. The fact that the typical business model of utilities has dramatically evolved over the past decade and continues to evolve. You see on this chart in the upper part of the slide that about 10 years ago, since 2008, you had close to 50% of the EBITDA of European utilities, 42% precisely in 2008, close to 50% of the EBITDA was stemming from conventional power generation activities. Conventional power generation meant very much fossil fuel driven and highly dependent on the external price of commodities. So that was a pretty volatile merchant business, up to 50% of the cash flows of those companies about 10 years ago. That proportion today has dropped to about 10%. This is a sample, by the way, of the 10 largest utilities in Europe. So it's fairly representative. This proportion has dropped to 10%, while today what is interesting is that you have about 80% of the EBITDA of those companies, which consist of either regulated networks or fully contracted renewables businesses. This is a major evolution, which has not only led actually to enhanced returns, but also maybe even more importantly here, which has led to a massive de-risking of the business model. And I think, again, this is a phenomenon which is largely overlooked, a phenomenon where Europe is ahead of the world. As you can see, so in Europe, you've got about a third of the EBITDA now of the largest utilities, which comes from renewables activities. It's less than 10% in the US. So the US, North America in general, and the rest of the world is only at the very beginning of that phenomenon, which we believe is highly supportive to the space. One last illustration of that phenomenon is what has happened here in the UK. You are all familiar with the fact that the UK used to drive the bulk of its power generation out of coal. actually was still close to 50% back hardly more than a decade ago. 2008, 48% of UK power generation was coming from coal. This proportion was less than 1% last year. So in about a decade, the UK has entirely phased out of its coal to transform its model into renewable, clean energy sources, including biomass for the case of Drax, which I'm sure most of you are familiar with. So this is a salient phenomenon, which we believe is one of the drivers of our strategy at the moment, definitely where we find the bulk of our alpha generation opportunities today, and I think it's a differentiating factor. Here is on this slide, thank you, James, what it means for the stocks which have succeeded in implementing that transition to a cleaner business model and adapting to the energy transition. We've taken 3 examples. Drax on the right-hand side, I just mentioned. You see the outperformance in green of the stock versus the European Utilities Index. The transformation of Drax from being one of the largest coal-fired power generators in Europe and carbon emitters to now a clean power generator based on biomass has led to massive outperformance. Same for RWE, radical transformation in 2018, becoming 2/3 wind and solar through an asset swap with E.ON. Look at the outperformance that this has led to, and a re-rating of RWE, which was back in 2018 a stock trading at about 10 times PE. It's now trading on 18 to 20 times. And NextEra at the bottom, world largest renewable developer, a traditional US utility in Florida 10 years ago, which has dramatically transformed its business model to now become, which has now become one of the leading renewable and wind developers in the world. And as you can see, again, a massive outperformer versus its own space of US utilities. So that gives you an idea, I think, of what we are looking to identify, those opportunities in the space. Another characteristic, which I think is also an opportunity and largely overlooked, is that the space has now significant inflation hedging characteristics. If you think of January 2022, we were starting a year with the prospect of higher interest rates and high inflation worldwide. Definitely not the kind of context you want for a bond proxy type of sector. And as you could see from the performance numbers I reminded you about earlier, clearly we haven't suffered from that phenomenon. Why is that? Because actually inflation hedging has now become much more significant for the infrastructure and utility space worldwide. First of all, because you have countries where you have direct inflation indexing formulas as part of the regulatory framework. The UK is very much used to that, but a growing proportion of countries are now including inflation pass-throughs. Italy, Portugal, some US states, some Latin American countries. This is a model which is spreading, and obviously in our portfolio, we've been favoring those companies at the expense of others, like the Spanish regulated ones, for example, which don't have that inflation hedging. Pricing power, that's the case of a lot of transportation infrastructure or water business models, environmental services, also very supportive and with a significant ability to pass through inflation. And then some cyclical tilts. That's mostly what has happened to commodities and power prices. It's been supportive, obviously, in the past 18 months, I would say. So inflation hedging possibilities with the strategy well beyond, I think, what a lot of people, generalists, would tend to think. And there is a pretty much the last point here, which I wanted to highlight before moving on to the topic of political drive, which is the valuation gap. Yeah, that's the next page, James. Some people would think that, you know, with the recent performance in 21-22 of utilities infrastructure, the space has become expensive. Actually, you see on the left-hand side that global infrastructure are actually trading very much in line with their past historical range. We're taking the past 13 years here. Relative P relative to the MSCI World, premium to the MSCI World, but actually very much in line with the historical range. So to some extent, the phenomenon that I've been describing has hardly been taken into account by the market. But also there's one phenomenon which I believe is bound to be very supportive, is the interest that private equity operators are showing for listed infrastructure. We are seeing obviously massive inflows of cash, private equity operators, but also significant consolidation happening in the space, notably on the back of the energy transition phenomenon. We are listing here the example of the Australian market. Three of the largest listed infrastructure names in Australia got taken out in the past 16 months. Sydney Airport, Spark Infrastructure, AusNet. So 3 takeouts, all of them by private equity groups. And 3 other Australian listed infrastructure names are currently subject to an approach, let's call it this way. So either through expressed intention to bid for the companies like Origin or AGL, or interest expressed by IFM Infrastructure, for example, for Atlas Arteria, which is a toll road operator listed in Australia. We find it quite relevant. We are only starting to see this happening in Europe, but we believe the fact that listed infrastructure are trading in general at about a 50% discount to what private equity operators are ready to pay for similar assets is very revealing and actually extremely supportive for listed valuations going forward if this phenomenon of integration and consolidation continues, which we believe will be the case. So these would be the main points of the opportunity, but I can't finish that presentation without mentioning what you all read in the press about a significant political drive, which also is bound to help our space. The vote of the IRA, the Inflation Reduction Act, by the US Parliament last year is a groundbreaking game changer. $600 billion. The US actually suddenly realizing that out of the 10 largest renewable developers in the world, they only have one ranked, which is NextEra. The other 9 are either European or Chinese. Isn't it highly unusual for such a fast-growing area and a space which is very much driven by new technological improvements, not to see more US presence? I think the Biden administration and US Parliament in general has been very conscious of that, and the vote of the IRA is bound to be extremely supportive to renewables in general, to nuclear in particular, and also to infrastructure, with, as we know, massive capex requirements in a large part of the US transportation infrastructure world. What we find interesting is that, as we know, Europe is also considering a similar program as of today. Last year, European governments decided to agree on a Repower EU program, which, to be honest, was very much a sort of a letter of intent to accelerate the development of renewable energy, with no clear budget allocated to it. I think what is interesting is that the latest discussions around it are much more promising and could very much mean a significant booster, pretty much equivalent to what the US are doing with the IRA. So those are supportive political drive elements. I know a lot of you would consider political intervention is typically a headwind for utilities and infrastructure. Well, it's become a drive, and a very supportive one, and a tailwind. So I think that's a phenomenon which will only be helpful to the stocks in our portfolio and the universe. That's pretty much it. I think, James, the next page is the portfolio structure and characteristic. I'm showing it, obviously, in case there are questions about it, a lot of names which hopefully you will recognize, a lot of large caps, and with some fairly good geographical diversification so as to avoid any individual country risk.
Great, thank you very much. That's actually quite handy with this time, so we can tackle the first question on top of this. So, in terms of, you mentioned about the risk associated with emerging markets, but do you see opportunities there? Partly sort of linked to the fact that they're sort of growing faster than developed world counterparts.
Yeah, I mean, we see a lot of opportunities in emerging markets. To be honest, we are increasing at the moment our exposure to China in that respect. We've been very reluctant to having exposure to emerging markets in general and China over the past couple of years for reasons we all know about. China's reopening is a potential opportunity, especially given that China has some of the largest wind operators in the world. We have 2 in the portfolio. And also we have added now a Chinese water distribution name in order to not only get exposure to the Chinese reopening, but also to the overall thematic of water, which we think is part of our thematic and definitely will benefit from capex requirements and investments there. So I would say, yes, opportunities in emerging markets, but usually with a much higher risk profile. Given the underlying structural trends we see in OECD economies, we think it's worth staying cautious, keeping a cautious stance on emerging markets. For example, we don't have any exposure to Latin America at the moment. There will probably be opportunities in the long run, but obviously much more uncertain than what we see in our typically industrialized economies as of today.
Okay, thank you. That's useful. Just popping back to this slide, what's the sort of main benefit that you've seen already from in the US and the Inflation Reduction Act? What sort of differences it's actually made on the ground?
So in the US, the program, the IRA, will mostly take the form of tax credits. One, probably the most immediate impact is the return of nuclear. I alluded to it. Frankly, a couple of years ago, we work at Ecofin with a lot of US colleagues. Not many of them would have bet on a future for nuclear. The US had taken the decision to continue with the existing nuke fleet, but with no plan to renew this, as opposed to some countries in Europe or the UK, as we know. So nuclear is one of the main immediate beneficiaries, because Biden has now decided to suggest a program to extend the life of the current nukes, subsidize some investments there through tax credits, and I believe the next step could well be a new generation of nuclear fleet in the US. That remains to be seen. So nuclear clearly immediately, renewables in general, and then with a longer term view, new technologies like green hydrogen are likely to be beneficiaries of the program, as tax credit are going to incentivize companies to spend in research on the space. At the moment, it remains negligible, but it's one of the technologies which could really change the picture with the 10 to 15 year view.
It's quite handy that that's such a citywide article that I'm writing down. Thanks anyway. Do you think actually that they've done enough to close the gap with Europe, or will sort of Europe pull ahead again if it does its own version?
I think it's massive. I was telling you, so top 10 renewable developers, only one US name. In 5 years' time, you will have 4 or 5, no doubt about it. The US are notably building a very integrated solar value chain. The US, as we know, like Europe to a large extent, are largely dependent on Chinese solar panels at this stage. Germany 10 years ago tried to develop a solar industry, but it got decimated by cost issues and the competition from Chinese solar panels. The US have taken the decision to build their own chain of solar PV, and that could be very quick. Actually, we think that in 5 years' time, the US will have their own chain, integrated chain for solar, with a very competitive cost basis, notably thanks to the incentives I mentioned. So yeah, I think it's $600 million, and the real intention to bring the whole chains back to the US. That could very much represent significant competition to Europe, hence the intense discussions in Europe at the moment to find an answer to that.
Do you think that the actual full effect of the IRA is actually still, is it already priced into American utilities? And then a secondary question to that is have European utilities already moved on the back of the potential for a European version?
We actually think it's still ahead of us. We haven't seen yet the effects of those programs in the earnings of those companies. If you look at the behavior, share price behavior of the US utilities, it's interesting. The program was voted in July. US utilities performed very well in August, September, and then they collapsed, mostly driven actually by the interest rate shape and the US long bond yields. And it's some of those names have now retrieved the last part of what they had gained on the back of the IRA. So I think the market remains skeptical, wants to see the effects in the numbers, and that's something which will be more for the next 2 to 3 years than on the basis of what we've seen the past 6 months. Same for Europe. If you look at the valuations of most of those European utilities, which we believe at some point would be beneficiaries, including from US programs, a lot of the European operators like Iberdrola in Spain, Enel in Italy, EDP in Portugal, have significant exposure to the US renewables market. Those companies are trading at a massive discount to their US peers. Typically, they're trading on about 12, 13 times PE, when a typical utility in the US is trading on more than 18. So you have a big discount to a lot of those European names, which actually are global and will benefit from the US program, and obviously also from any decision which may come out of European discussions at the moment.
Looking back at this chart, these sort of 3 charts here, I think you sort of mentioned, you alluded to it, but how much of this is sort of a result of multiple expansion, as people think these things are less risky, perhaps, or perhaps have more growth? And how much is actually the sort of increased earnings coming through?
Well, there's clearly been some multiple expansion. I mentioned it for RWE, so from 10 times to close to 20 times in just something like 4 years. So groundbreaking, obviously. But also the case of NextEra is interesting. And I mentioned that the typical utility in the US would trade at about 18 to 20 times. Well, if you look at NextEra, it's actually trading on more than 30 times PE. If you look at Ørsted, a name which some of you will be familiar with in Scandinavia, it's trading on about 35 times PE. So you have clearly a multiple expansion and re-rating for those names which are exposed to the fastest growing areas of the space. So it's not only that the market values the decarbonization phenomenon. In our view, it's mostly that by moving out of fossil fuels and getting exposure to the clean power energy sources, those companies are suddenly becoming growth engines. NextEra is a company which now provides assurance of double-digit annual increase in its own dividend for the next 3 years at least, and actually we believe for the medium term. RWE, which was a cash cow, has become now a double-digit EPS growth company. Same for Drax, where potential for growth is significant. And we've seen, again, with the results they published yesterday, actually some good growth characteristics. The market was disappointed somewhat by the immediate publication, but it's recovering a bit today. But Drax has become also a growth engine. So I think it's that transformation which the market values, and where you see a big divergence with those utilities which have kept an old-fashioned fossil fuel-driven business model, which much lower growth and lower and more volatile returns.
There's a good question here, actually. Is how important is it in terms of your performance to avoid the losers as well as sort of pick the winners?
It's a good point. It's always very difficult to answer to that. We've managed to avoid the losers, to be honest, in the past few years. I think our approach to environmental matters are focused on ESG, obviously on the E of the ESG, has helped us in the past. I'm going to mention one example, which is PG&E, famous Californian utility, which back in 2017 was considered one of the best business models you could find in type of secure utilities in the US with a very favorable regulatory framework. Then the first wildfires appeared in the US, in California, back in autumn 2017. And we decided to dig into the environmental exposure and liabilities that those type of situations could lead to. We discovered that actually a company like PG&E had unlimited liability on those types of climate change related events. We took the decision to fully exit the position across our portfolios. And those of you who follow the space will know that a few months later, PG&E went into Chapter 11, bankruptcy. So, that's maybe it's a bit of an extreme example, but this is how we've managed to avoid the big pitfalls of the space in digging into their environmental issues, which we see that again at the moment on the water space in the UK, source of pollution through wastewater, which ended up directly in the sea without any treatment. And the Ofwat is now thinking about potentially heavy fines for operators like Pennon. Environmental issues, pollution matters are an increasingly sensitive angle of the space, and we're paying particular attention to it at Ecofin. This is part of our DNA. So I think this has proved helpful to avoid the pitfalls of the industry.
Yeah, thank you. You talked a bit about the sort of opportunity in nuclear. Are there ways to play that you can access?
Well, most of you will regret that EDF has now been nationalized. So no more opportunity there. You have a few opportunities through, first of all, some of the European integrated utilities, company like Iberdrola do have some nuclear exposure, but in the US, maybe more importantly, there are a couple of companies, one of which is actually one of our best contributors of 2022, is Constellation, which is a spin-off of Exelon, traditional US utility. Interesting that this company that spun off its nuclear business about a year ago, and this proved a very smart decision. Constellation has been considered one of the main and most obvious beneficiaries of the US IRA. So a few names like this, not that many. So it's a difficult theme to play. It's increasingly a state-owned type of sector, nuclear, given the obviously heavily capital-intensive nature of the business and long duration of the investments required.
Okay, thank you. One of the sort of things we saw a couple of years ago in the sector was the sort of sudden launch of this digital infrastructure funds. Is that something that you've got any exposure to or you're interested in?
Not so much, James. We try. I mean, we would have indirect exposure to those types of technological improvements, no direct one. We don't want actually to have exposure to technology because this is not our specialty. We don't want to be directional. in the type of technology which will end up winning. But obviously, some of our companies do benefit indirectly from this phenomenon. I would say all the network operators are gaining a much efficiency and productivity through the implementation of smart meters. So technology does help, but no, for us, the companies we invest in, this is a very negligible proportion of their earnings. And it will only be through indirect effects that we will have exposure, not directly.
Okay, thank you. If we switch tack a bit and just talk about sort of more high-level stuff about how you go about managing the fund. So first question was about the size of the team. I think we've got a slide here. So do you want to sort of say about the depth of the resource within Tortoise Ecofin, please?
Yeah, sure. I think the key to have in mind at Ecofin in London is that we are one investment team, and then we have separate identified strategies starting from the analysis of the common investment universe. The strategy we're talking about today for the trust is again our oldest historical strategy at Ecofin, but we also have more impact-driven strategies. We have more thematic strategies across the effects of the energy transition into various sectors of the economy. So what we gain at Ecofin, I believe, is the cross-fertilization of our perspectives on the same investment universe. We also have colleagues based in the US. We're not on this slide. Tortoise and Ecofin have now merged. So Ecofin part of the Tortoise Ecofin group, which is $10 billion AUM group. And Tortoise's background is very much into energy and commodities historically. So that brings us significant expertise in the understanding of the global energy markets. We obviously interact on a daily basis with our colleagues in the US. And there's a last angle, which is that we also have within Ecofin a private equity business based in the US, which specializes in US wind and solar projects. There's actually a listed entity in London for this called Renew. So we have a closed-end fund here as well for that type of strategy. All of that is put together. So we try to combine the various perspectives to a common investment universe. In London, we are a team of about 15 investment professionals. We have another 25 in the US, but more for the upstream energy markets. And we also have a team of around maybe a bit short of 10 people on private equity.
Okay, thank you. In terms of the sort of portfolio construction, there's a question around position sizes. So something like next year is 6.4% of the portfolio. I mean, how big would a position get, and how do you sort of trade around things? And also, can we ask what's your turnover, please?
Sure. Turnover is around 30%. We have quite a heavy process internally to add a new name to the portfolio. We spend a lot of time meeting with companies, with regulators. We build our own models. We use the rest of the team for each analyst's pitch as a sounding board. So it's quite a hefty process to add a new name. So turnover around 30%. For the trust, since inception, pretty much. Then how do we construct a portfolio? We have a total of between 40 and 45 names, average position around 2.5%. The sizing of the positions is very much related to our degree of conviction. We have imposed ourselves a soft limit at 8% of the portfolio. So our prospectus allows us to go well above to 15, but our soft internal limit is 8% because we consider that a name which reaches that type of weight in the portfolio starts to overly dominate. And we want to keep a risk profile in line with our historical mission and very much what we've imposed ourselves. So, and the last thing maybe to mention is that we are putting the emphasis on our top 10 positions. You have the list here in front of you. Historically, these have been the main drivers of alpha. So we want at least 35% of the portfolio among the 10 largest holdings that you have in front of you.
How do you use gearing when you're managing the fund?
So we have this interesting gearing facility in our prospectus up to 25%. Actually, we will not go beyond 20 for security reasons. At the moment, our gearing is around 13. And I would say typically in average over the past 6 years, it's been around 10 to 12. So we are towards the upper end at the gearing bracket at the moment, which reflects our degree of conviction in our portfolio. Gearing is fully discretionary and in the hands of the portfolio manager. Obviously, it's being tracked by our board, but we have, as PMs, quite a high degree of flexibility, and that allows us actually to keep some margin for maneuver when you have big market events. And we've had some in the past. I still remember shortly after we launched the trust, we had the election of Donald Trump in the US, which was all about boosting economic growth and cutting subsidies to clean energy, because as we know, the Trump administration was highly skeptical on those matters. So in pretty much a couple of weeks after the election, the whole space collapsed by something like 15 to 20%. In the US, but also in Europe. That led us to identifying great, compelling opportunities to buy our preferred stocks on the cheap. And in these types of situations, it's extremely convenient to have the facility of some gearing to have that flexibility to use sort of opportunistic approaches.
Good, thank you. And then, have you got any plans to try and grow the fund?
Yes. We are thankful to be trading at a slight premium to NAV at the moment. Interesting that for its first years, the trust was trading at a discount. It moved to a premium back, if I remember well, something like in April 2020. Interesting.
We lost
timing.
There we go.
Sorry.
There you go. We lost you just for a couple of seconds there.
Yeah, sorry. So premium to NAV at the moment. We've been issuing on a regular basis through Stifel, which is our main broker, issuing small equity on a fairly regular basis. We'd be interested, yes, in launching a higher equity raise at a premium, obviously, so only enhancing for the current shareholders. We think the strategy is worth it, and it's also a very scalable type of universe. So we'd like the trust to grow, yes, indeed.
Yeah, it could be a lot bigger, I think. Good. Well, thank you very much for that this morning. That's really helpful. If we didn't get to your question, apologies, but there was an awful lot going there. So thank you, John Hugues, and we'll sort of no doubt be writing a note to you in a relatively short term, and we'll get you back on the show again in a year or so's time, if that's all right.
Thanks a lot. Thank you,
James.
you for your time. Thank you all. Thanks for
you.
the questions. Bye-bye.
Cheers.
Bye.
We will be back next week talking to the manager of Octopus Renewables, which I think is quite an interesting fund. It's more sort of European focused than a lot of the other renewables funds that we've got in the sector. and then VH Global the week after that. So there's definitely sort of a renewables thing going on here. But to counter some of that, we're going to have talking to Witan now on the 17th of March. So I hope you have a good week. Thank you for tuning in today. And if it has, we'll talk to you again next week. Thanks. Bye-bye.